So first thing is just to welcome everyone along to part 3 in our series of really informative webinars where, as Earlypay, we're very focused on education and support of the wider community in the SME space. So having Kirk and Sam along today from NCI is fantastic, hugely informative, and I think certainly some of the pre-feedback I've had of this webinar, gents, is that you're a hot topic right now with the economic environment we find ourselves in. Everyone's very intrigued to see what you might have to add today and give some value on. So so exciting opportunity to learn a lot today. I guess just to introduce Sam and Kirk briefly, and then you guys can introduce yourselves. But Earlypay work very closely with NCI. They actually are, they support us with putting in place all of our own trade credit insurance policies and the security measures we use there as a funder ourselves. Hugely experienced, hugely respected in their sector. So we're very lucky that you guys have kindly given me time to support us with this program today. So thanks for that. And like I say, our relationship's a strong one. So trade credit insurance is something that Earlypay and debtor finance in general, but certainly Earlypay value very highly. In terms of educating our clients on the value and benefit of using insurance to protect against the risk of bad debt, and obviously for ourselves as a lender to protect our organisation in the same event. And with the economic environment we have now, it's more important than ever, I think, that more people are informed about the benefits and why you'd use trade credit insurance and really how it applies in the current marketplace. So just way of a little intro while a few of you joined, and it's interactive. The goal for this to be interactive today. So we'll probably spend the first 30 minutes or so just, I'll ask some questions of the gents and we'll have a bit of a conversation, but please do use the questions and answer section to drop in any questions you've got on the way through. And then hopefully for the last 15 minutes or so, we'll go through some of your questions and hopefully the guys can give some solid answers there for you. So I might just briefly for a minute, Sam, Kirk, if you just want to introduce yourselves and just explain your roles at NCI, just so people can understand the true value and what you represent, because you're very experienced individuals in what you do.
Thanks, Lee. Appreciate that and welcome everyone. I'm the Group Managing Director at NCI. So I've been with the company for 33 years, and I guess my role is to make sure that we're creating new opportunities for our clients, partners, to ensure themselves or protect themselves against a bad debt, and make sure they're managing the process of their credit risks along the way. So that's my role. We have offices all around Australia, New Zealand, and in Asia. So that's where our branches link out to. Over to you, Sam.
Thanks, Kirk, and thanks, Lee. Appreciate the opportunity to do this today. So my name's Sam Turtle. I've been with NCI for 12 years now. I think that's a long time. And then if I'm anywhere near Kirk or one of the other seasoned veterans of our industry, it seems like a short time, but has given me the opportunity to progress and gain a lot of experience with the industry. And I've been working with Earlypay in particular for the last 3 years, helping them with a lot of the arrangements that they do have. So that's me.
Thanks, gents. Look, we might just kick off with, I think most people understand what trade credit insurance is as a premise. We've got an educated group, I think, in terms of the attendees, and I think as we chat, we'll get into a bit of nitty-gritty on it. But why don't we just start with the market as a whole, if you like. We've gone through some serious economic changes. COVID feels like a bit of a distant memory now, but obviously I understand that had a big impact on the trade credit insurance sector, and different insurers didn't know which way to move. And we've sort of rolled from that now where we're feeling, I suppose, the economic impacts of COVID now really starting to come to the fore, with interest rates going up and failure rates in certain sectors increasing. So I suppose I know that both of you, whoever's best placed really, what's the sort of trade credit insurance market looking like so far in 2023? And I suppose to that, what changes or movements are we seeing in the marketplace at the moment?
Yeah, thanks, Lee. I mean, back in March 2020, all the insurers thought the world was going to fall apart, as did a lot of businesses out there. And in fact, the opposite happened once all the government funds and support packages came into play. So where the market or the trade credit insurance market is at the moment, it's a really competitive market. All the insurers are looking to get back to the norm. They are open for new business. Their assessment and credit ratings as far as buyer assessments is almost at all-time high levels. And I think the comfort of the support that governments around the world put in over the last few years, and where businesses found themselves in a good cash flow position, unusually through that period of time, has protected them against the cliff or the fallout that people were expecting. So as far as new business quotations, competitive pricing, options from the market, the different insurers, and limit approvals, it's very open at the moment, and probably one of the most competitive times that I've seen, despite, I guess, the feeling or sentiment out there about where the economy is heading.
Interesting. And do you feel, Kirk, that is the fact that they had the big fear of COVID, and they were very sort of bull and bear market, wasn't it, to an extent, pull back on limits, etc. The hit hasn't come. So is that normal in a market we're seeing now where if you open the paper, you should be fearful of stepping outside, sort of thing? We're back to that. Is recession looming? Is it normal to see insurers be bullish now and actually say, well, now's our chance to get limit in the market and bring new people to our sector? Or is this different to what you would typically expect to see in the market we're in?
I think it's still very unusual compared to what happened. I mean, my only comparison is back in the GFC, where once the government support came back into play, it was very a short period of time, and insurers opened up again. I think what's happened over the last 3 years, and one of the benefits of our industry or the trade credit insurance market, is they've had a good term someone used, a long runway to correct any issues or figure out what sectors could be a problem. And that was around initially hospitality, entertainment, travel. Of course, we saw insolvencies like Virgin Airlines, and that's where I think they had that initial shock, and then they've had a long runway to shift out those buyer risk or company risk that they thought were going to be heavily impacted by the COVID or the non-trade periods through lockdowns. And they've had a long time to wash through their book and make sure it's in a healthy position. And I think that gives them confidence about what position they're at at the moment, and where potentially businesses are at for the short term at least, and giving them confidence to be able to write those risks and get more information to be able to help them underwrite new credit risks.
Interesting. Okay. So on that, in the credit risk, one of the questions that, pre this webinar, a few people that couldn't make it reached out and said, oh, I'm interested to hear about A, B, and C. And one of those is obviously the trends. A lot of people like to see trends. And I think certain sectors, and trade credit insurance is one of them, it may be a lead indicator to what others are going to feel or what's going to happen in the economy. And one of those things people are particularly interested in is, are there any trends, or talk us through the trends you're seeing in payment defaults and insolvencies in the current market? So again, excuse my ignorance, but there'd be an assumption that you guys are well placed to see a particular sector's payment terms are going out, the debt terms are increasing, etc. So just, Sam, Kirk, talk us through that and what you're seeing at the moment.
Yeah, so sorry, Sam, you go ahead.
No, sure. I was just going to say, look, it's certainly from vast majority of the indicators we keep an eye on, it is starting to get a little hairier. Construction, if you're looking for a specific industry, because trade credit insurance is so heavily exposed to it here in Australia, we see that being one of the industries where risk has increased the most. I'll let Kirk give you a little bit more insight.
Yeah, I mean, one of the things, Lee, we do every quarter is we do our risk index, and the risk index initially went stupidly high back in 2020, and that was because of the risk factors around credit limits and initial repayment plans, collection actions, and insolvencies. We saw a spike in a very short period of time. What happened after that, and what's happening now, is that people had that cash flow through the support. At the last quarter of last year, we saw an uptick in the repayment plans that have now led to more collection actions. And for the first time in a number of years, our claims team last month had received the highest level of claims they've received for 3 years. So there's definitely more insolvencies happening. There were a couple of really large insolvencies in the construction space, residential home building, etc., where, because of the false economy that we had over the last few years, and the incentive in particularly in residential housing, we had this massive uptake of approvals in new housing because of the incentives from the government. We then saw factors with labour shortages, increased labour costs, increased costs in materials, especially for building a house. Anybody who has built a house or tried to build a house over the last, or renovate in the last 2 years, have definitely found it's taken a longer period of time, and it's been more costly because of these factors, the inflation factor. Now interest rates have kicked in. There's just going to be another big drop off in approvals, and that's going to be put pressure on businesses because they run their cash flow on the basis that they've got always new approvals coming through and new deposits versus having to complete jobs, and that's going to the massive swings in approvals then drop-offs is going to cause problems for people because how do they manage their cash flow? How do they manage their labour force? How do they manage their payments to their suppliers? And I think that has caught a number of people out, and where we've seen some of these non-profit jobs that have been happening through residential building and construction come now and hit home, and of course the insolvencies.
What about sectors? I mean, if someone had to guess which sector's suffering in the market, you'd probably guess construction, right? And for all the factors you just mentioned. Obviously, you've only got to be connected to a few people in finance or insolvency to see names like Scott's Transport, etc. as well. That these bigger recognised names in certain industries obviously have ripple effect. So, are you seeing what is? And again, I get it's a weather forecast, not an exact prediction, but there's a knock-on effect of, I suppose, sectors associated heavily to construction and in other support sectors where, say, fuel costs are going up. What are the ones that you would say or think the domino effect, if you like? I mean, you look at someone like Scott's Transport and you assume it's a big company with strong balance sheet and good cash flow position, and clearly not to some level. So is there a pattern we can expect in terms of what you see go next, or is it not quite so predictable, Kirk?
Yeah, it's a bit up and down, but any business which is highly geared or relies on capital is going to have to tighten the belts. I mean, you look at even the IT sector throughout the pandemic period. I mean, everybody's buying laptops, systems for work from home. The shortage in microchips, all of these things cause a bit of an issue, but a lot of software, IT capital, high capital type businesses are going to now, with the higher interest rates, have to really monitor where they set their priorities. You look at what deposits or funds have had impact on Silicon Valley Bank and these other factors that are starting to come into play now. Yes, maybe those businesses had issues anyway, but the quickness of the change of the economic conditions around inflation and then interest rate controls and all of that's what's having an impact on these type of sectors. So anybody that's highly geared, maybe transport where they have high capital costs, leasing, all of a sudden those expenses have become really high in their financial capabilities, and therefore they've had to readjust, or they can't afford to pay back these elements. I think also the businesses that have high requirements and labour hire, ups and downs again of where people are going to need labour. There's shortages, and now they might have difficulties with paying for those the inflated labour conditions. It's going to start to kick in, especially with the high labour costs. Profit margins are going to get squeezed, and they've got to make decisions to make. And I think that is what we're about to see over the next 12 months. All of those factors are going to start to accumulate, and that's going to put businesses under pressure.
Yeah, interesting. Thank you. Maybe, Sam, if I can ask, and someone's just dropped a question actually, so can we maybe give a brief description of trade credit insurance and kind of how it does help? And I might dovetail that with, not only what it is and how it helps, but why businesses are considering trade credit insurance. And I suppose that's the key, is the benefits of taking out a policy, because much of what we just talked to in the first 10 minutes there is a really good segue to suddenly understand why something like trade credit insurance, that if you're ill-informed, and you're looking to cut costs in your business and you go, well, what's this line item and it cost me X a year? It's like any insurance, right? The value's there when you need it. But do you want to just talk to that, Sam, so people understand truly what the value is, kind of how it works in basic premise, and and why businesses would buy it?
Sure. So without going into too many technicalities of what was in the policy, because it can be very different and tailored for each individual business, the core of it is it protects you against insolvency or protracted default of any of your debtors. So if you are offering credit terms to a customer, there is an inherent risk that comes from that, and from everything we've already been discussing this morning, those risks are increasing. So trade credit insurance is the ultimate protection to make sure funds can go back to your business in the event that there is an insolvency of one of your customers. So I mean the benefits, the main one is the ability to get the cash back to your business, but really providing you a bit more security and a real discipline and improvement to credit management practices is another major one, and certainly for a lot of businesses in the SME space, that can be a huge benefit, almost as good as actually receiving the cash back, because you can use a lot of the disciplines that the insurance policy puts on you and your business to minimise the chances of actually having to claim on the policy, and that's a huge benefit over time. I'd like to throw a few more in, Kirk.
Yeah, look, I mean, Lee, I think one of the major issues is that you sort of have a country where the she'll be right, mate type attitude applies. And what's the more likely event? Your warehouse burning down from a fire, or one of your debtors becoming insolvent. The reality is the higher chance of one of your debtors becoming insolvent. And, you know, people buy this product, one, out of fear, one, out of just good management. A lot of people buy, 1 in 5 of our clients get additional funding or finance because they do have a security against their debtors ledger that they can offer their financier or their bank or the funder, because it's an asset. It then becomes an asset because it's secured. So the benefits from a credit insurance policy for the cash flow coming back, as Sam said, from a claim can go to their financier, and it then can open up a lot of factors for growth, for additional sales, for expansion, because they've run out of bricks and mortar to get extra funding, but they're using their AR ledger or customer list to be able to use as an asset to get more funding. It's one of the real benefits. Better information. I think a lot of people at the moment, you know, they're very good at selling their products or services. They're not always keeping an eye on their customers, and therefore one of the side benefits of trade credit insurance is you're getting a helping hand on which customers you should be trading with. Is there any adverse information on those customers that you're existing? And you can react quicker to this information flow that's coming through to, you know, the CFOs or the credit departments. They get a lot more data and information, and that helps them make better decisions about who they're trading with.
Yeah, it's interesting. I mean, to sum up what you both said, is rigor, right? What people underestimate is actually the rigor that their business gains from using something like trade credit insurance. And as you say, and not everyone's got a credit team there being able to assess the credit risk of their customers. And we see it, many SMEs, you know, that you sit with, and they forget what they're doing, which is when you talk about offering trade credit terms, you're effectively operating as the bank. You know, it's like them going to get a loan from the bank and the bank assessing their credit worthiness as to whether they will extend them a line of credit. We've sort of lost into it should be a right attitude. You're right, Kirk. We've lost a bit of an understanding, I think, in the market. It's become second nature and normal for certain sectors, construction, transport, labour hire, to just have to offer credit terms. It's the normal way of doing business. And in essence, we've forgotten that that's actually still a measure that needs to be checked and balanced. And, you know, if you can't get the money today, are these people worthy of extending credit to? And, you know, I can echo what you said in the sense that we have many clients ourselves, that new ones that apply for debtor finance to accelerate that cash flow, and will apply for a limit, and NCI and our insurance policy will say, look, no, there's no limit available, or we'll cap the limit at X, Y, and Z. And while first off, it might be a bit confronting to the small business owner to say, well, what do you mean you won't fund any more than that? When they truly start to understand why, and the data that we're able to get, and the understanding of why that limit's being capped, you really start to see them become better business owners. You know, rather than chase every dollar today because there's an invoice I can get out the door for a job I've done. What's the point of that if it's not going to pay back, and I'm going to have to spend the next year making back the loss of profit and the loss of cost, etc. So, yeah, it's interesting to see what the rigor does and how it actually changes the mindset of the business owner. You know, and often again, wouldn't necessarily always say the case, but often you'll see businesses go backwards in revenue before they go forwards. But at the same time, their profitability just went through the roof in the same year, because they've taken on less risk and better quality of debtor. So I can second what you're saying in the way it builds. It actually builds better SMEs, if you like, when they put something like this as the foundation in their business, certainly from our experience, at least as a lender. Can you just talk to, again, there's a number of finance brokers on the call, and it'd be interesting to just give them some insight and explain to them how financiers gain the benefit. And obviously I know how, but it's important for you guys to talk to it. But for them to understand why financiers get a benefit from their clients going and obtaining an insurance policy, particularly where we're talking about cash flow lending or working capital lending, and without leading the witness, just help them understand how it brings value to me as the lender and my ability to take on insurance, if you like, from that policy and use the correct terms to help them understand that.
Yeah, so I mean, obviously, at the end of the day, you want to get the deal done, right? You want to get the funding deal done. That's the key part of what you need to do. So any tools or different elements that can come into play to get that deal done, I guess is the key. And I guess the benefit is knowing that if it's a borderline case or it's a little bit difficult, sometimes adding this extra security layer, and it doesn't cost a lot, adding the extra security layer is going to help that debtor or that customer or prospect become a better risk. And then the credit teams or the people assessing it are going to say, look, it was borderline, but with this extra support here, yes, let's do it and let's do the deal, because there's another layer of comfort. And you want healthy clients, right? So, you do a hell of a lot of work finding these customers, building relationships, working with them. You want them to stand the test of time. You want them to be a successful business. And I think, like you were just saying, Lee, you do get a better business. They grow up when they understand, or they get the support of a finance broker or a credit insurance policy or information, whatever. They all of a sudden become a better business. And like I said, they're great at selling their products or services. What they need support with is how they're going to fund it, how they're going to create the framework around that to be a better business. And I think having a healthier client is one benefit. Getting the deals done can come with this extra bit of layer of security that we traditionally find.
Just to add, and Lee, you mentioned it before, the domino effect or contagion risk is one that gets thrown around a lot in the media at the moment. It is real risk, and trade credit insurance is a perfect stop to that, because if they have especially for one of their major customers, an SME has a large loss there, their major buyer goes insolvent, that can push them under as well. And if a funder is taking security over the debtor's ledger, the knowledge that you're going to get 90% of that back if there's a credit insurance policy in place can give you a lot of comfort.
Yeah, for sure. Again, growing businesses, right? The pains we see with many growing businesses is you've worked from, pick your construction sector or your transport sector, you've done mum and dad type jobs and you've got small customers, and then you might get that first big customer and the terms generally want to get bigger and it's 30, 60 days. And then you get that concentration risk for a while there where that one customer represents your business, basically. The others become insignificant. And I think for many small business owners to be able to push through that period of time and spread their ledger again, so take that one big customer, turn it into 10, so the risk of any individual failure is less. I think if you could correlate that to the failure rate of businesses, you'd see there's a direct curve that matches, in the sense of it can be very, very hard to push through that period. A, from a finance perspective, which is obviously where we come to play and support that growth piece, but B, to accept you're going to make some mistakes, and that's the reality of it. Without systems and processes behind you, you're going to make a lot more mistakes, but with good systems and processes, you could still make a mistake, because the reality is, trade credit insurance often does pay out, and it makes a big difference to these businesses surviving, which indicates that even the very best don't know exactly which ones are going over tomorrow, right? So it does make a huge difference to a business's longevity and chance of success, in my experience. So yeah, second everything you guys have said there. You mentioned it in there, I think it might have been yourself, Kirk, it's not as expensive as people think. So I might be a bit pointed and stick the finger in the wound there for a moment, but it's the same as any finance mechanism or insurance mechanism. It's only as good as the value you get out. But just help people understand, because not everyone's familiar with trade credit insurance. How do you access it? If you're a finance broker today and you're assessing a small business and for example, you think it's a good transport business needs some debtor finance, for example, people know where to go, they know what to do. Where do they go to get their clients or themselves, for that matter, access or conversation on trade credit insurance? How does the insurance mechanism work, and how does the actual cost component of it work in terms of the fee structures?
Yeah, sure. That's a good question. And I guess the market, like I said, is very open. So there's bespoke insurers in Australia and around the world that do trade credit insurance. So there's about 5 to 6 in Australia that we can go to as a broker. We'll get some basic information and go to the 5 or 6 insurers and do all the hard work for them to see who can offer the cover, who can offer the best terms, and with our experience, understand which insurer is going to be able to offer the best I guess terms and conditions for that particular industry. But as far as the cost goes, a lot of people, when they hear of trade credit insurance, and I say, how much do you think it's going to cost? They go, oh, it's probably 2 or 3% of the trade, and it's actually a tenth of that. So the mechanism, the way it works is the insurable sales or the credit sales of what that business is making to their customers. That's the insurable risk. So whatever invoice is going out, and then there'll be a premium rate that's attached to that, depending on excess levels and industry and all of that. But let's just say it's an average rate of around 0.3%. When you're looking at an invoice going out at 75,000, where you'd get 90% cover on that through the insurance, that's costing you about $225 to have that $75,000 invoice secured. And I think if businesses looked at the risk of and the rewards of getting paid, no matter what happens, you're going to get paid 90% of that 75,000 invoice. If you don't have 0.3%, and I'm just using an average rate, 0.3%, well, your margin's wrong to start with. And you think of the risk of, if I don't get paid by my customer, I might struggle to pay my supplier, and that causes bigger cash flow issues, or you have to go into an overdraft, which is going to cost you 10, 12%. Having this small mechanism in there at, say, 0.3, 0.2, 0.4%, depending on those variables, is something that should be affordable against those invoices.
Yeah, it's interesting because insurance can all get thrown in the one pot, right? The general insurance for businesses or the house insurance if you're a homeowner. But I've always looked at trade credit insurance and thought, well, anyone that's only used to insurance for their own personal reasons, you're in control of whether you locked the car or whether you crashed it today, or whether you set your house on fire because you left the gas on. With trade credit insurance, you're not in control of what your debtor's doing. And I think that's always the key I've expressed to many business owners is you're taking a best guess on what's going on in their world. And who in reality holds their hands up and puts a sign on the door to say, we're running out of cash today and we're struggling, please don't trade with us. I'm yet to find one, so if someone can find me one, please do, but it doesn't seem to happen. So I think that's the other key is the reality is this is the non-controllable you're insuring for, that most business owners that have been trading for any period of time have had to book a provision in their P&L for bad debt at some point in time. And your point's probably a valid one, Kirk. If they added up the cost of that relative to the value that it gained back and the cost of the insurance, it probably is a no-brainer for 99.9% of those businesses over time. So thanks for that. That makes complete sense. The other thing I think that, and again, we go a bit off topic here a little bit, but the other thing I see, and I've seen it when clients of ours have been paid out, for example, on insurance, and I think people forget sometimes we're very technical about insurance and finance and what does a business need to move forwards, but many of these businesses, especially when we use the words SME, they're still the founding owners. There's still people trying to build their own wealth or create something. They're not big listed companies all the time that you could argue have less of a soul, and it's boards of directors that aren't as in contact. So in a world where mental health's a bigger problem than ever, I've seen it personally, the relief and the pressure and the stress that can come off a business owner, knowing that the worst has just happened, but because they followed the right foundation in their business, it's not going to take them down today. You'll have seen that more than me, and I'd imagine that, and it never is, but the big novelty check handover to the client at the right time must be one of the most rewarding parts of the industry. So can you just talk for a moment around that and what you see when, in terms of the relief and the words people use when they do say get a payout and realize just what they've done to keep their world moving forwards?
Yeah, we've had people in tears. We've had people saying, you've saved my marriage, you've saved my house, you've saved my business. And it is very satisfying because, the reason why they took it out in the first place, they may have been, umming and ahhing. It definitely has shown the benefit. And, one of the main reasons we get when we ask our clients, why have you bought trade credit insurance? That they say it helps me sleep better at night. We go to insolvency meetings or creditors meetings, and you have people there going, I'm going to lose everything. And you say to them, or we've got clients there who they're comfortable, they're, not smiling, but they know they're going to get funds back. And others are saying, well, I didn't even know about this product. And I think one of the key messages to your partners on this call today is that just getting the word out there and the message and this is available, but not many people, the saturation point of trade credit insurance in Australia is very low. I mean, people don't know this exists. And I think if there was more people that used it, there would be a lot more businesses who felt more comfortable when they're trading. They'll sleep better at night. These owners are risking everything starting a business. And we quite often see other businesses fail because of a major insolvency, the domino effect. But yeah, like when we do, we get lots of lovely messages from husband and wives, sole traders who've said, you've just saved my business if I didn't get these funds. And the insurers are really quick to respond when they know there's a company that is potentially going to fail if they don't get their funds. We've had claims paid on the same day, within 24 hours, just to make sure that they don't experience the fact that they're going to stress out or fail because of their insolvency of one of their debtors. Sam probably has a lot of examples where he goes out and we don't unfortunately hand checks out these days, but when that direct deposit goes in with their funds, we get a lot of happy calls.
Absolutely, and it does make a huge difference, especially for smaller businesses. But beyond just the claim payment and the obvious benefit and appreciation that clients get from that, there's also a really, really good and great appreciation of the fact that the tool can be used to help them grow their business. They can figure out, all right, what are the risks that they actually want to be taking and who they want to be trading with. And a lot of business owners do really come to us and thank us and pass on very lovely testimonials saying that, look, they've really helped NCI and trade credit insurance has really helped them make more sound decisions about who they're trading with and under what conditions.
For sure, Sam. We've got a few questions rolling in, so I might ask you one more question myself, and then maybe divert to some of the questions coming in. And again, any other questions you guys have got, please put them in the Q&A section there, so that we can try and get through as many of those as we can. Just on insolvency risk, I guess what we're talking to here really is de-risking your business. And again, you open the paper, things are failing left, right, and centre. And these webinars we're doing, this whole series is really around those that attend and ourselves learning off each other, just being better educated to advise our clients in terms of our knowledge and experience of what's out there. So if you're a finance broker there and you didn't know about trade credit insurance, you've armed yourself post this 30-40 minutes today with an extra string in your bow, just to help your clients be better business owners as a whole. And I think, again, debtor finance is a sector where you see businesses grow at a rapid rate or potentially enter our world when they're in a distressed situation, how they're going to turn that around. So more so from your experience than as professional advisors, clearly you're not there to give professional advice on how people should run businesses, but what's your tips on managing the risk of insolvency, I suppose, and what you through your years of doing what you're doing around the trade credit insurance space, what are your tips and I suppose areas of wisdom there that you might pass on to people?
Yeah, there's probably 5 things we see credit managers do very well. And if they're doing these elements, they're going to have less problems or less issues when a customer is not paying them. So the first thing is knowing who you're trading with. Make sure that when they are filling out an application form, that they're getting the right details on that company, so they actually know who they're dealing with. We all have salespeople and they walk in with a post-it note and say, hey, I need to load the truck for this customer. But make sure you know who you're dealing with and get that information correct. Set payment terms and set the rules around dealing with a customer. So if you're going to give them a $50,000 credit limit, let them know what it is, let them know what the terms and conditions are, and advise them what will happen if they don't pay. Have a system in place that when someone does become overdue, make sure that you have a process of collecting that or putting the pressure on. No small business really enjoys collecting money or ringing for, they don't have the time for one, but they avoid it. So if you're not going to have an automated system or something where you can chase up your overdues, at least engage a third party where they can write out a letter for you and try to get that money in, because it's going to compound your issues if you're not actioning when an account becomes overdue. Registering your security interests. Again, and not a lot of people know about the Personal Property Securities Act. If you are supplying goods, you need to register that you're trading with someone or supplying goods, so that in the event of an insolvency, you have the ability to ask for those unpaid goods back, or at least negotiate with the administrator to get those goods back. So make sure that you're registering your security interests, or get credit insurance. One of those things where it's just the ultimate cover. If you're doing all those other elements, you're going to be a lot ahead of the game. But of course, you don't always back the right horse, and sometimes you have something fail, and when that happens, make sure that you're going to get some recoveries one way or the other.
Only one I'd add is just to make sure you've got a system for regularly monitoring the accounts that you have open and the credit you're providing. Look, if you do have credit insurance, that is part of the service that's offered. But if you don't, it's well worth looking at a system to make sure that you are regularly checking and that their situation hasn't changed. Might have been good to open the account a year ago, doesn't mean that they are still in a strong position now.
Good advice, Jen. So we see it with our clients. I think that's why debtor finance as a mechanism and trade credit insurance go hand in hand, right? The nature of the sectors we support for finance are a no-brainer that they should be looking at trade credit insurance. But the administration of your policy is obviously so important, and your underlying T's and C's as a company is very important. It's something we look at closely. And what proof of debt do you get to show that you actually did deliver those goods? And so, in a way, that's why we find, I think our clients value it so highly, is we've put in place good practices with them to help them be better business owners in terms of us wanting to fund their invoices, which at the same time has fulfilled what they need from a trade credit insurance perspective. And you talk about that collection side, and again, depending on the client, they've either got systems and processes already, or, for example, we've got clients with our full service offering where we're doing the collection work for them. We're administering their aging debt. We're reporting to the insurance on the fact that, look, we've got some aging debt on the ledger here. So I think, again, for anyone listening in, where if you're a finance guy today as opposed to an insurance guy or girl, so to speak, then whereas you may look at certain mechanisms as overdrafts and things that are simpler or cheaper, again, when you listen to this and talk to the fact that what's the underlying foundation that business owner's building rather than just what they need money for today, I think and I hope people start to see where the value is and how you can really set your clients up for long-term success with a platform of things like debtor finance and trade credit insurance together, far greater than their competitor who's got cheaper funding today maybe, but can't compete in the open market in the same way, or take some credit risk that's going to put them at risk of failure tomorrow. So it's really good to get you guys on, because I think it does hopefully bring home to people how you consider finance and insurance differently to just what's the raw cost of it and what those combinations look like for clients. And again, with the goal being to be better advisors to all of our clients, I think this knowledge helps do that, and the client's better informed to make the right choice then. Do I take bank-based funding? Am I interested in trade credit insurance? Do I take debtor finance? Have I got a concentrated ledger with one big customer and I've never really thought about it before, what risk they represent to me? So I think they're all sound points you guys make. But I think we might take just a couple of questions that we've got here, and then we'll give people back 15 minutes in their day, because I think that's been really informative, and we'll finish on a high, so to speak. But one question is, I've heard that insurers only insure good risks. Is this true? Now, there's a great question for a trade credit insurer. I love the answer to be, no, we insure everything. But I guess, guys, the reality is insurers do pay out, right? So they don't get it right all the time. If your attitude to it is that the insurers are trying to dodge the bad debts and not pay out, which I don't think is really the case, they're trying to help business owners make better informed decisions. But I'll let you answer the question anyway. I've heard that insurers only insure good risk. Is this true?
Well, I'm going to channel my inner Bruce McAvaney here and give some stats because I think it's the best way to answer this question. And that's, 95% of the time, the insurers are approving some level of cover when requested. So full approval. So you've asked for a credit limit, it gets approved. It's around the 75 to 80%. But the extra sort of 10, 15% comes in. At least you're getting something, and it's an informed decision. So if you're not getting the answer you want, or particular what risk you've asked for, you're going to get, hey, this is why we've done this limit. This is the additional information we could get to help get you up to the level that you've requested. But no, sort of the 90 to 95% of some level of cover. We do stats every quarter with our insurers, and that's generally where it sits at the moment. The 5 or 6% that don't get approved are not approved because of reason that they're in financial stress. There's overdue reports. They're in an industry where they're not making any profit. There's a repayment plan or a collection action already against them. So this sort of information, I guess, is what those businesses want to receive back as part of the service, to make sure that they don't open an account with someone that, after one trade, they're going to fail and catch them. So, yeah, I mean, it's a common myth of trade credit insurance, and those stats prove otherwise.
Very good. Someone else has asked about the wait time, or how long an approval takes, and I'm sure it's how long is a piece of string. Not everyone's the same, but again, I think it's important for people to understand: is this something they need to give 3, 4, 5 weeks of notice to a client to access? Is it, what sort of information needs to be provided? So I guess quite practical questions there, gents, on what does someone need to provide, and how long is it likely to take to get access to something like trade credit insurance?
Sam, did you want to cover that one off?
Sure. Well, look, decision times from the insurers vary based on the information they already hold about the customer that you're requesting on. So if all the information is readily available, very rare that we wouldn't get an answer within 48 hours. It can take a bit longer if there is a need for updated financial information from the customer. And then it is unfortunately very much how long is the piece of string, because it depends how long until the customer responds, if they'll respond, what information they provide, and if that helps the insurer make a final decision. But yeah, from our limit statistics that we make, vast majority of decisions from the insurers are made within 48 hours. I think last time I looked, it was up towards 80%. So it is a vast majority.
And just to add, I mean, there's two elements that can make that work even better. Under a credit insurance policy like Earlypay has, there's a flexibility or a pen given to you to underwrite your own policy up to a certain level, and based on that you can do X, Y, Z and put a process in place that pretty much, if those boxes are ticked, you can increase a limit or approve a limit within your own means, within seconds of being requested. So one thing that we always negotiate within insurers to say, look, for the smaller end, we don't want to hold up requests. We don't want to have to always ask for it. And sometimes we can get an adverse report or look at our own data, and we can use our trading experience, and under the negotiation, when we've done the start of the policy, it gives you your own pen to be able to be flexible and approve your own credit limits in-house.
Yeah, thanks, Kirk. It's a valid point you make. So for anyone listening in that works with Earlypay or refers to us, we have our own policy, which we obtained through NCI, and obviously as a fairly large lender to working capital and cash flow, that's a pretty big policy ourselves. So we've got a number of flexibilities there, and ability to, as Kirk says, make decisions on the debtors related to our clients in line with the policy. So if you are looking at clients, transport, manufacturing, wholesale, labour hire, the usual sort of sectors we support, if you're looking at clients and thinking, well, actually debtor finance is beneficial and I really like the idea of TCI for them and they're a growing business, and then accessing the finance through us is a great way for them to be able to gain some value from trade credit insurance to protect them without necessarily needing their own policy. And equally, if our policy isn't able to support, or we're not able to get the limits we need through the way our policy is structured, obviously there's a power of an NCI behind us that we can then pass that client on to, or refer them on, or yourselves can refer that client on to say, look, we can help you with the finance, but actually you need to go and talk with NCI to go and scour the whole market for you, because actually the levels of concentration you want on a debtor, for example, is too high, or whatever it might be. And there's plenty of cases where, and 99% of the time we're able to service our own clients with our policy. There's plenty of cases there where actually you guys can find a lot more in the market for them as well, and that puts them in an overall stronger position. So yeah, it's a really good point you make there. One final question, a bit more of a technical one, and then I think we'll probably wrap up. What analytics do the insurers track, or in terms of sectors and their clients, to forecast their risk appetite? So it's an interesting question, I guess, around, we can read the papers today and see construction struggling, but I'd like to think the insurers go a bit more deep than that. Otherwise, we could probably all do it. So again, I'm sure they keep their cards close to their chest a little bit, but it's an interesting question. What sort of analytics, what are the things that drive the insurer's appetite there?
Yeah, look, I mean, I think one of the most important elements is our own ecosystem between the insurers, the information that we collect from customers. So as an example, NCI have 3,500 clients. Every month they're reporting to us who's overdue, who's not paying them, who's on a repayment plan, who's become insolvent. So outside of the normal financial information or mercantile agencies, courts data that you're getting, industry reports, we're getting this analytical data every month at an early stage. So it's not necessarily yet at a collection stage or whatever. We're getting this data, which we then accumulate, and we can see which sectors are under a bit more pressure. We can see which clients, individual clients, are under pressure. We might get 3 overdue reports on the same debtor or group in on the same month, and we go, what's going on here? And we wash that data through our own systems and use the insurer's data to make sure that through our own ecosystem and the information we're getting, we can give informed decisions out. As Sam mentioned, if they're monitoring, you'll get an alert to say, hey, we've just recognized this on this sector or this buyer, and you'll get those alerts so you can make informed decisions. And we monitor that and that on their risk appetite. So, one of the key elements is financial data. Obviously, if they can get that on a regular basis. We have analysts here ourselves. The insurers have analysts behind the scenes. They're getting loads of financials every day to wash into their system and assess. But it's in all the other data that's coming through that helps them with limit decisions. And of course, up to 50,000, there's one layer of as a credit limit. 50,000, there'll be some information they need. It'll ramp up to 100, 250, 500, over 1 million. There's different layers of information that they're going to require to make their assessments. But I think it's a really interesting point that there's information that you see in the papers. It's not always correct. It's not always giving the right trends. We're constantly every day looking at the data that we're getting from our customers to see, all right, is there more collection action? Is there an industry that's complicating things a little bit more? Are we receiving claims or insolvency notices from a certain sector? And we get all those analytics through our risk index. We launch every quarterly. We can every quarter we send out that data to people who want to know about that. The NCI Trade Credit Risk Index that has industry hotspots, states hotspots, and what we're assessing to make informed decisions on whether there's industries under pain or sectors or states or whatever we're having some pain.
Thanks, Kirk. Gents, really value you giving up your time. It's a busy market for you and us, so I do value you coming and spending the time with us. But again, hopefully the participants got some real value out of this, and the question suggests. So one of the last points was, is there any material or information brochures, etc., that people can access? And look, for sure, we'll make sure to obtain those, and they'll go out post this webinar to all attendees and all those that couldn't make it as well. So we'll send that information on, and you guys will be able to reach out to Kirk and the team there directly. So, gents, thanks for giving up the time. Hopefully people got a lot of value from that today, and we look forward to a long and lasting relationship with you guys still, and hopefully a few more people come that way and we can support a few more SMEs to be successful as well. So thanks very much, gents.
Thanks, Lee. That was great. Appreciate it.
Thanks for the opportunity.